Hi everyone. So today is our sixth session for strategic financial management. And last week we were talking about evaluating strategic investment opportunities. So basically, we covered the non-discounted cash flow methods and then moved on to discounted cash flow methods. So if I just kind of share with you what we did last week, just a small recap. So we, in non-discounted cash flow method, we spoke about the, as you can see, we talked about payback period. We just saw, like, did an example for y'all to understand how it is calculated. Thereafter, we did ARR, accounting rate of return, and we moved on to discounted cash flow techniques, where we explained to you about, I kind of explained to you about discounted payback method and kind of did a small example to try and help you understand how a discounted payback is calculated. And we kind of I think I did a small comparison for y'all to understand what's the difference. And I did like a brief discussion about NPV. I spoke to you what NPV is, and then what are the points we should consider in NPV. Those were things that I spoke about, but we did not do any calculation because we were actually going out of time. I just did like the explanation for NPV, and I even spoke about the advantages, the limitations, and I told that today I would be doing a sum related to NPV so that you can understand how a NPV, sum is being calculated. Because I explained to you, yes, NPV is one of the like mostly used discounting cash flow techniques when evaluating investments. Because one thing is, it is considered to be more suitable while calculating. And also for now today we will be talking about the IRR. For IRR method, we are basically going to calculate two NPVs, and using those two NPVs we will be calculating the IRR. So one of the prime things that we need to be able to properly do is to calculate NPV. So in order to get a proper IRR amount, you should calculate the NPV well. So now the thing is, yes, in advantages, I said, okay, time cash flows are used and the time value of money is considered for that, obviously, because we are using the discounted factors. And I also said it is consistent with the principle of shareholder value maximization. And in limitations, I said it is like if the fund constraint NPV will be of limited use and things of that sort. And today I will be kind of doing a sum with you. So now, as you can see now, as according to the illustrated example, it says that we need to calculate the NPV of a project discounting the cash flows with a discounting factor of 15% if the initial investment is 2,000 and 800 cash inflow for the rest of the project lifetime. And the project lifetime is 5 years. So now, here the initial investment is 2,000, right? And the cash inflow every year would be 800. So now, can you remember what we did for, let me just kind of move on with, try to understand what we did with discounted, discounted payback. So here we looked into, it is the same sum as you can see. So here the initial investment was 2,000, and then the cash inflow yearly was 8,000. We multiplied it by the discounted cash flow, discounted factor, in order to identify the present value of the cash flow here. And then when it comes to the discounted the payback period, what we did was we did a cumulative cash flow, where we considered how much cash flow is, remaining, and to figure out how much is used and things as such. So here what we did was we kept on, first it was, we had paid already, the initial investment was used as minus 200. Thereafter, when 696 came in from the 800, then we reduced it here, and then the cumulative amount was put. So obviously the investment, the minus amount was less. So it kept on reducing. By the third year, we had minus 172.8. And by fourth year, we had a positive cash flow, which is 284.8, which showed by 3 years and 4 months, according to the calculation, that we have recovered the initial investment. The main thing was we calculated how it was recovered. Now, the difference between the discounted payback calculation, if you look here, and the NPV, is that, see, the years would be same, the cash flows that you include would be same, the discounted cash flow would be same, and the present value of the cash flow will be same. Now let's see the difference. I just want to do a comparison so that you can understand, the difference. So what we are going to calculate here, what have we done? Look at it, it's the same thing. The first column is same, right? Oops, the first column is same. Second column, discounted factor for 15% is same. And the present value of cash flow. See, we have the present value of the discounted factor, which is 15%. The present value of cash flow is here actually. Discounted full cash inflow, right? The same thing is done. The difference is that when it comes to discounted payback, we have an extra column with a cumulative cash flow amount here. So it's the same thing that you're doing here. So as you can see, so 0 years cash flow into the discounted factor 1. So this would be minus 200. And then, okay, then you keep on calculating 800, 696, 800, 604.8, and you keep on looking at it. You see that 303 by 5th year, it would be 397.6. So what basically happens is here we will be doing a cumulative amount here. So minus 2000 and then plus 696, 604, 526, 457, 397. So we just kind of do an addition here. So what we do is we add all these together, okay? And then we add all these cash flows together and then minus the 2000. So as you can see, the amount that we have, is it more than 200, 2000? Yes, obviously, right? So it will be a positive amount. So accordingly, because the amount is positive, according to NPV analysis, project is considered to be profitable. So here, yes, the addition is not included here. However, but as you can see, obviously 600, 600, 5, 4 is 10, 10, and obviously 6 and 6 is 12. So that means in 4 years, obviously, this 2000 is kind of covered. So by then, it would mean that the NPV is a positive amount. So the basic thing about NPV is that, so here, I might have kind of, yes. So here I kind of explained to you that if an investment gives a positive NPV, it is likely that the investment will be proceeded. And if it's a negative NPV, obviously it will not be considered or undertaken. Or if the NPV is 0, then the management will decide. So as you can see here, it's a positive NPV. Therefore, this seems to be profitable. Therefore, generally, according to the NPV analysis, it will be considered. Right? So this is how we calculate the NPV. So I mean, it's good for you to remember the difference of how it's calculated. So just let me do a small recap for you. Sorry, I'm just skimming through all these. If you look here, we did the, yeah. So initially we did the payback. What did we do? We did the year. Oops. We did the year cash flow, and then we took the cumulative cash flow, right? So what happened when it came to discounted payback? For this, we added the net cash flow we multiplied by the discounted factor and got a discounted cash flow amount. Then we included the cumulative cash flow, right? So that's what we did here. Hold on. Sorry about this. Yeah, so what happens is here, cash flow, we included a discounted factor of 15%, and the present value was calculated, then the cumulative cash flow was calculated. So, sorry about that. So now when we look into the NPV, so discounted cash flow and the discounted cash flow is kind of included here, and then it is added up. A summation is checked to see whether it's a positive value or a negative value. This is a positive value, so obviously it's profitable. So but one thing that we can obviously understand is that, see, when we look at the discounted cash flow in the third year, so minus amount, this is minus 172.8, right? But by fourth year, it becomes, it's a positive amount. So that means obviously, according to your knowledge, you can see that if it becomes positive in the fourth year in this, that would mean that the NPV would be positive here, obviously, because we are calculating for 5 years. Something to think about. Okay. Okay. Now we will be moving on to profitability index method. So here, okay, in profitability index, what we do is we take the NPV and it is divided by the investment amount. So now NPV is, now here they say that the NPV is biased towards higher investment requiring project. That is, the higher the investment, higher is the NPV. So if the capital is unlimitedly available, such understanding could be argued. So one of the things that we need to understand is, obviously, higher NPV would come in if it's a higher investment. Sometimes it could be a higher investment because then there'd be higher cash flow as well. But if we do have this limitation in the investment, the funds, obviously when we are taking a decision based on the funds that we have, obviously there should be some way that it could be selected well. So therefore, the profitability index can be calculated. As you can see, so in reality, capital need tends to be limited in companies, obviously. So they have to select between those investments, give them the highest NPV. Highest NPV, however, just because it's just highest NPV does not necessarily mean that it is the most suitable method. So in order to mitigate this issue of, having a higher investment value related to higher NPV, the profitability index can be calculated when there's a situation like this. So NPV can be divided by the investment. So then the one with the highest present value, net present value, can be identified in profitability index. So the main advantage under this profitability index is that it helps to identify the project that gives the highest NPV when capital fund is limited to decide between 2 or more projects. So now let's say we have 5 projects that we are calculating NPV, right? We do the discounted cash flow. We did the discounted cash flow, obviously it's positive. And then we do the NPV. It's all positive, different amounts. But do we just take the one with the highest NPV? We take the one with the highest NPV, the investment amount quite high. Are we taking that risk, or are we going to take 2 other projects? That's a decision that the company needs to take. So for that, something like PI can be used, where the net present value is divided by the investment. And according to the PI, the company can decide upon which one has the highest NPV related to the investment. So that is what we do with the profitability index. So here, so calculate the profitability index of the project in which the investment is 2,000 and the NPV is 171 pounds. So NPV is 171 divided. Sorry guys. So NPV is 171. It is divided by 2000, which is the investment amount. If that is so, the profitability index would be 8.6. So the same thing, if the NPV amount here is not 171, it is 200, and the investment amount is 2000, then obviously the PI will be higher. Okay. Similarly, let's say the net present value is 1000, 2000. Okay, in PV, I'm just giving you an example. However, the investment amount is high as well. It becomes like 5000. If that is so, the PI percentage will be less. So just because we look into the NPV, does that mean, by merely looking at NPV, we can decide upon the best suited method? No. Something like profitability index will help us decide upon the most suited method for investment analysis. Now we are moving forward to another step where we try to identify the IRR, or the internal rate of return. So when it comes to IRR, it can be calculated using this formula, as you can see, A plus B minus A into A minus B. Now you will wonder what is this exactly. So basically, what happens is basically what happens is like I told you, in IRR we use two discount, we calculate NPV for two discounted rates, right? So just let me explain to you using this. Let me explain to you using the example, and then we'll move on to, like, what it means and things of that sort. So IRR, basically this is a formula that was developed, so we just kind of follow it. So what we do is A here would be the discounted factor. As I told you, two discounted. So basically, before doing an IRR, what we need to do is we will have to calculate two NPVs. So here in this, the calculation of NPV is not included here actually. So the DCF. So here what they say is you need to calculate the IRR if the NPV with the DCF of 15% and 20%. And they've actually given you the NPV amounts as well, which says it's 171 and 192, right? So this is a calculation that is separately done, and then the amount is already given. So basically what they do is they just obviously tell you, okay, right, there are two DCF amounts, that is 15%, 20%, and then they tell you to calculate the NPV amounts, thereafter add it into the IRR. Here, just merely explaining the NPV again would take a lot of time, and we'll be wasting a lot of time on it. So therefore, here, as you can see, the amounts are already given. So what we do is the first one, the A thing, what we do here is, as you can see, A, that is the simple A, means the discounted factor amount, right? And simple B is the higher discounted factor. So the lower discounted factor was 15%. So here you include 15%, and the higher discounted factor is 20%. So you include the 20 minus 15. So 15 plus 20 minus 15, which is into A. Now, A is capital A is the discounted fact, the NPV that you, the amount that you get from the discounted factor 15%, which is 171, right? So as you can see, A, simple A is the discounted factor for the small amount. The capital A is the NPV from that small discount amount. And as you can see here, the capital B obviously is the NPV from the 15%, which is the small discounted factor. Just remember A would be the small discounted factor and the NPV related to it. The B would be the big discounted factor and the NPV related to it. Okay, so as you can see, when we calculate, we add 15% here. 15% is 0.15 plus 0.2. 20% is 0.2, right? 0.2, or you can say 0.20 instead of having an extra zero, the zero is reduced. So 0.2 minus 0.15, okay? So as you can see, this is minus the simple A, this is the simple B, into 171, which was capital A. Capital A was the NPV of 15%, which was 171. And then you reduce the NPV from capital A down here, 171, minus the NPV from the higher discounted factor, which is minus 192. So minus 171 minus 192 would become what? Minus would be plus. And you do the calculation here, how the IRR would be 15%, 15% plus. First you do what is inside the brackets. So minus 2 minus 0.15 would be 0.05, right? So multiplied by 171, thereafter added by 0.15 divided by the amount that comes here, which is 171 plus 192. The IRR would be 17.35. So according to this method, now why do we calculate IRR? I didn't explain that to you, right? What is this? I mean, we just did a sum, and now let us try and understand why did we calculate IRR. So as you can see, IRR can be used as a means of eliminating the limitation of using a fixed discounted rate for the entire life of the project, which is a main disadvantage in NPV analysis. Now see, before we did the NPV, right? We did the NPV, and we even took the profitability index in order to identify whether the NPV amount is high. However, we were using a fixed discounted rate, right? So, I mean, can we be 100% sure that the discounted rate is fixed? No, it's not. And especially in a period of 5 years, it could differ, right? So that is a main disadvantage when it comes to the NPV analysis. In order to eliminate this, the IRR is calculated using 2 discounted rates. So that is what we did here. So this provides the range of discounted rate for a project to evaluate its viability thereby providing a margin of safety in selecting the discounted rate, and it also considers the time value of money. So we said NPV is a very good method. However, there are disadvantages. So what happens here is we using PI, what did we eliminate? We eliminate the fact that, you know, a higher NPV would just, if we have a limitation of funding, obviously, we have to figure out the one which is most effective. So we did the PI calculation. And when it comes to IRR, what did we do? Now we are eliminating the use of main disadvantage of NPV, where we are using a fixed discounted rate. We eliminated that using the IRR, and we try and evaluate the viability of the project using this method. Because it would be providing a margin of safety with related to discounted rate and considers the time value of money. I mean, why are we calculating all the discounted cash flow techniques? Because we are considering the time value of money. However, if we are just using a specific amount that we decide upon, like we say, okay, right, 15% is the discounted you know, cash flow amount or discounted factor. We think that is realistic. No, it's not. I mean, you cannot predict something that is going to happen in 5 years, a cash flow that is going to come in 5 years. Therefore, there is a limitation. So there should be a margin of safety related to what we decide upon. And that is what is being done here. So the main disadvantage in this method is that it involves complex calculations which are difficult to understand and interpret. So main disadvantage, as you can see, it is a formula where you are supposed to kind of just calculate, and you don't know why you're calculating it either. You'll be like, okay, right, A minus B minus so B minus A, and then you just do a mathematical formula. This was developed, and we are going to follow it. And we try to interpret based on that. So that is IRR. So so what does this 17%.35 mean? Okay, why did I calculate? Basically, 17.35 is the amount, you know, the amount in which the NPV, the DCF amount in which the NPV will become 0, right? IRR is basically the amount in which the NPV of a particular calculation will become 0. So anything above that would mean hold on, sorry. Okay, so this would help you kind of understand it better. Yeah, now moving on, we'll be doing the suitability, acceptability, and feasibility analysis, which is a non-financial evaluation, as you can see. So now we calculated all the financial evaluation methods, and now we will be considering the non-financial evaluation method, which is the suitability, acceptability, and feasibility framework. So what is this framework? This is basically introduced by Johnson and Scholes in order to ensure that there is a methodological comprehensive evaluation, which is not exactly mathematical, but something which would consider the non-mathematical kind of mathematical kind of factors related to the investment opportunity. So what is suitability? So suitability basically, what will it determine? It will determine whether like the strategic alternatives which is identified would kind of help a firm to exploit the opportunities and to kind of overcome or avoid the threats of the environment. Now, I mean, just by calculating, can you figure out, okay, whether there are opportunities by using this method? Or will they be avoiding any kind of threats? Are these considered while we're calculating using the discounted cash flow method? No, we don't, right? But we need to consider all these. So that's why a non-financial evaluation needs to be done as well. So that is what suitability means. So it could, so basically when it comes to suitability, it should basically capitalize on the firm's strength and the competency, co-competency, and to align with the existing culture and the broader macro environment. All these will be considered. And so basically what happens is they will check whether it's suitable for the current situation of the firm. So in suitability, what do? We try and see the strategic alternative will help the organization exploit some kind of opportunity. What are the opportunities that this would kind of, that particular project would kind of help the organization? So suitability is that. And what is, so basically when it comes to suitability, there are certain questions that are considered when accessing the suitability. First is, you think, okay, is it in line with the firm's corporate appraisal? I mean, does it use the strengths? Does it overcome the weakness and capture opportunities and try to protect the firm from threats? So what they basically do is they kind of see, look at the corporate appraisal or the SWOT analysis, I should say, look whether the strengths are used, weaknesses are mitigated, opportunities are captured, or threats are being protected from. So these are being checked. And also another question that will be considered would be whether is it in line with the firm's mission and the current course of action. How well does it help organization strategic objectives? So one of the things that we kind of tried to understand was that whatever we do in the organization, first thing is to kind of whatever that is developed should be in line with the organization's strategic objective. So therefore, even when we are considering the investment opportunities, these need to be considered, whether it's in line with the firm's mission or current course of action. So using this non-financial evaluation, this could be done. So, so we spoke about suitability. Thereafter, we will be kind of trying to see, sorry. Okay, going to, sorry. So we will be talking about acceptability. What is acceptability? So basically, we will be mainly concerned with the risk and return. So risk and return of the investment will be considered, and basically the key stakeholders' expectations, like obviously the shareholder expectations, the lender's expectation, the management, government, all these will be considered in order to say whether it's in line with the expectations of the stakeholders of the organization. So the concerns that will be considered under acceptability is, how will this impact on shareholder wealth? So obviously the shareholder has an expectation, so that is to maximize the wealth, obviously increase the wealth. So we will probably have to look into whether how it will impact the shareholder wealth, whether it will increase. And also things like, will there be any significant effect on capital structure? Obviously, shareholders will have an issue if there is a significant effect, where the capital structure would differ, where their holding is reduced, then obviously they'll have an issue. And will there be any significant changes in the organization's work structure in terms of department, group, or individual? So this will basically be related to the employees and management. Obviously, if the work structure in terms of departments and things are kind of, it is changed significantly, obviously, there'll be issues with those stakeholders. Therefore, in order to check the acceptability, all this will be considered. Thereafter, we'll be considering feasibility. Now, what is feasibility? Here, this is where we assessed whether to determine whether the organization has the resources to carry out the investment, whether they will be evaluating the existing resources in order to support the investment. Okay, and like basically it's an evaluation on internal capabilities, and like different models will be used here in order to kind of figure out the internal capabilities, such as the 6M model, which basically stands for money, machinery, manpower, market, materials, and makeup. So what will be considered here? So financial projections of the companies will be considered. Reactions of the competitors will be considered, and also the previous track records of the company, and whether the company has undertaken any similar investments will kind of be considered here. So now that is the non-financial evaluation to figure out whether the strategic investment opportunity, evaluating the opportunities, and in order for the organization to choose upon the most suitable strategic investment. So now we will be moving towards the role of treasury in financing and controlling the working capital. So what is treasury? On role of treasury and financing controlling working capital. So what is treasury? Treasury management is basically kind of responsible for managing the cash flows. So obviously, as you can see, managing cash flow is crucial to any company because it's an important measure to financial health of the organization. So as you can see, the calculations that we did before were all involved to cash flow to determine, whether the cash flows were correct and all that. So obviously, managing the cash flow well is very important. So fundamental aspects in managing cash flows would include things like treasury management, which should identify the best way of financial short-term operation of the company, like in a way that minimizing the funding cost and matches the cash flow needs of the company. And also kind of things like managing the short-term assets of the company, or even financial risk, managing the financial risk with which the cash flows are exposed, such as interest rate and exchange rate. So now working capital management. So what is working capital? Basically, it refers to like the capital which is available for the day-to-day operations of an organization. So for that, how do we calculate it? The current assets minus current liabilities will be the working capital. So in this regard, what happens is the amount of current assets over current liabilities is basically financed by long-term capital. So working capital management basically involves what? Managing the relationship between the current assets and liabilities, obviously, and ensures the operations will be kind of run smoothly and that there are sufficient funds in order to meet the operational expenses and maturing short-term debts. So basically, as you know, current liabilities means the liabilities that we are supposed to pay in a short term, right? Current assets are the assets that we have, which can be made cash very quickly, or have a short-term kind of assets. So in order to have a good operation, obviously, the current liabilities will be maturing in short term. Therefore, there should be extra funds, sufficient funds to meet these operational expenses. So therefore, working capital is very important to any company, because holding too much working capital is inefficient, and holding too little is dangerous for survival. So having too much of working capital is also not, I mean, it's inefficient, because obviously, like, if we can use it in long term, that means it will be more efficient. However, if it's too little, that means the organization operations cannot move on, and which will be a big issue. Now, let's look at the objectives of working capital. Basically, working capital management would involve liquidity and profitability. That means the cash flow and the profit. So what is liquidity? This is basically to have enough cash ready to access to meet all the payment obligations when they fall due. And liquidity or cash flow is very important as a profit, because unprofitable companies can survive if they have liquidity, and on the other hand, profitable companies can fail if they run out of cash to pay their liabilities, or the wages and suppliers and all that. So liquidity is very important, because profit is something which is accounting, right? It doesn't necessarily mean that the company has a particular amount of cash in there. So liquidity will determine whether the cash would run out or not. So main sources of liquidity are basically cash in bank or cash in hand, obviously, and short-term investment that can be cashed easily, and cash inflows from normal day-to-day business operations like the sales and payments and things of that sort. The overdraft facilities or ready source of extra borrowings are also called main sources of liquidity. And profitability, obviously, as you know, is concerned with investing funds in source of maximizing shareholder wealth. So basically, financial managers kind of tend to invest in the minimum possible amount in working capital, and irrespective whether the assets are liquid or not, and this enables the funds to be used for other investment that could increase profitability. So basically, finance managers will try their best to increase their profitability. So that is very important. However, in order to make sure that there is a kind of the operation runs smoothly, obviously, there should be a balance between profitability and liquidity, and the perfect balance need to be considered by the organization. Now, moving on. Now, let's look at the role of treasury in financing working capital. So, treasury has to kind of ensure that the finances in the working capital is the most efficient, and the treasury can select from various policies discussed below to finance their working capital. So, one is the conservative policies. This is where the working capital is financed through the long-term sources. So emphasis is to ensure liquidity rather than profitability, and the company takes very low risk. So aggressive policy is basically the other thing. So working capital is financed through short-term sources, and so emphasis obviously will be on profitability rather than liquidity, and the company will take higher risk. So basically what happens is, if the working capital is financed through long-term sources, that would mean the company is taking low risk. If they are using short-term sources, they are taking high risk. So those are like the two sides, which is the conservative policy and the aggressive policy. Now we'll look at like the middle path or the moderate financing policy, where the company ensures that there is a balance between the short term and long term in financing working capital, and the emphasis is the balance between the cash flow profits and the risk. So basically, moderate financing policy is very important. However, the company can decide upon whether they are using a conservative policy or aggressive policy as well, but there will be repercussions as well. Now, we'll look at the liquidity and profitability. What's the difference? So controlling working capital is an important aspect for any organization, as you know. This is because basically if you have liquid assets, we don't have liquid, holding too much liquid assets is inefficient. That would mean that they will not generate any returns and reduce profitability. Okay, so holding very little liquid asset will improve the liquidity, but cause serious effects on the survival of the company. So basically, as a general rule, the company wants a little money to be tied up in working capital as possible in order to make sure there's no issue where the company operations cannot be properly running. So however, there are always trade-offs as well. So the most obvious problem is running out of cash. So a company cannot pay wages or is unable to provide services because of you run out of vital resources. Especially, let's say, a manufacturing company, in order to produce, they need the kind of products, and that means you need to have cash in hand to, or some sort of short-term method to pay the raw materials and services and things of that sort. So therefore, in order to run a manufacturing company, for the operations to be properly running, obviously, this should be properly managed. Now, and we will be going at financial and strategic objectives. We're talking about objectives, right? So financial and strategic object, what does that mean? So basically, employees see their responsibility has been limited to the boundaries of their position, but not in the context of an organization. So basically, if you look at the regardless of the position on role, working towards the objective related to the organization's ultimate mission is very important. So basically, what is the mission? This is kind of like the company's main purpose, the long-term purpose. Based on specific performance objectives or goals are being considered, as you can see, and then based on these objectives, specific plans. So specific plans in order to achieve this mission and objectives are done, and then the tactics of implementing of strategies will be conducted. So as you can see, so it's very important to have a mission, then based on it to prepare objectives, then the strategies, then the tactics. So everything in the organization will be decided upon the mission or the vision of the company, and thereafter, based on it, it will be separated like different objectives. Based on the objective, the strategies will be selected, then the tactics based on that, the company operations and how the finance field, the HR and the operations will work towards how will differ. I mean, that is how it will be kind of decided upon in an organization. Now, when we look at the financial and strategic objective, we have to see that the corporate objectives of a business is very important, whether it's a business or commercial oriented as opposed to financial, the corporate objectives are very important. So let me give a few objectives that are generally used. Something like, okay, one objective is customer loyalty, that is to supply products, services, and solutions to high quality and value to the customer in order to earn their respect and loyalty. So having customer loyalty is considered as a corporate objective. Thereafter, another objective could be the profitability or the profit. So if there's sufficient profit to finance a particular company of its growth and other corporate objectives, in order to increase value for the shareholder, then it is considered as a corporate objective. Another corporate objective would be the market leadership, which is basically to kind of maintain our existing supply and in order to expand into new areas that build upon existing technologies and skills and customer needs, those will be considered. The next corporate objective is the growth. So what is the growth? This is basically an opportunity for growth by using profits and organization capability in order to kind of develop and produce innovative products and to kind of satisfy the changing customer needs. Now we spoke about customer loyalty, profit, market leadership, growth, and now we'll move towards the corporate objective called employee commitment. So what is it? This is to kind of enable employee to benefit from the organization success by rewarding them their performance, to create basically like a safe and dynamic, inclusive environment, which would kind of value the employee diversity and their contribution and to help them to kind of gain a sense of pride and achievement for their work. So employee commitment would kind of benefit the employees' success using the organization success. So global citizenship. Global citizenship basically is another corporate objective, which is basically to fulfill the responsibility kind of towards the society by being an economic, intellectual, social asset to the country and the community as well. So as you can see, these are the basic examples. There are few basic examples of corporate objectives for you to understand how these objectives are kind of prepared and why it is prepared. So moving on, talking about corporate objective, it is basically varied from the financial objective of an organization, as you can see, because they pursue like multiple objective and not a single one. So on the other hand, like when it comes to financial objective, it is mostly linked to what? The profit and the profit maximization of the shareholder, right? However, so we use something like ROCE, ROI, or EPS, return of capital employed, return on investment, and and then also there are objectives pursued by the financial management, focusing on maintaining a capital cash balance and specific gearing ratios and stock turnover periods. Okay, so one thing that they would consider is shareholder wealth maximization, which is to increase the level of dividends and capital gain, and profit maximization is to increase the profit after interest and tax, and the EPS, which is earning per share growth, which is to increase the profit attributable to each share, and then the sales revenue maximization, that is to increase the market share. So as you can see, these are the financial objective, and we also spoke before we spoke about some other corporate objective. Moving on, so now we have to see organization to achieve their financial objectives. It will basically be achieved if their strategic objectives are met. because strategic objective in comparison will take a longer period of time. So when an organization kind of achieve the financial objective in short term, medium term, strategic objective may have to be kind of forgot. Is because they focus on benefits that satisfy employees, the stakeholders, instead of looking into the big picture. An organization has a risk in long run for not achieving the strategic objective, thereby not achieving a position in the market and creating a competitive end because of the focusing on short-term financial objective. So one thing that we need to see is, I mean, just merely looking into short-term objective will sometimes, forego looking at the strategic objective. So, and then the whole company method of achieving strategic objective will not happen. Therefore, it's very important that everything is in line with the strategic objectives, not just short-term objective. Okay, so yeah, so we need to I think finish off today's class with these objectives. And thank you everyone for listening to me, and I hope you understood what I explained, and I hope to see you in the next class. And thank you everyone. See you. Bye everyone.